Hi everyone, we are group number 35. Today we are going to talk about Sri Lanka's telecom giants, Dialog Axiata. Established in 1993, leads the market serving 17 million customers with mobile, broadband and digital services. As the nation's largest foreign investor with 3.26 billion invested, it drives innovation through its managing parent company. Contrast with the Sri Lanka Telecom Holdings, the national provider with 160 years of history. Now, for modern ICT solutions leader, it delivers 4G, 5G services and pioneered fiber optic infrastructure, supporting Sri Lanka's digital transformation through government Malaysian matches through partnerships. Both companies are listed in Colombo stock market, but represent different approaches. Development as the agile market leader versus mobile as the established national provider driving nationwide connectivity.
Dialog reported a gross profit of 48.7 billion rupees from sales of 102.93 billion, resulting in a gross profit ratio of 47%. This means Dialog retained 47 cents for every rupees earned in sales before covering other expenses. In comparison, SLT Modular recorded a gross profit of 28.46 billion rupees from 69.71 billion in sales, giving them a gross profit ratio of 40%. In summary, Dialog outperformed SLT Mometer by 7 percentage points. This suggests Dialog may have better cost control or pricing strategies, giving it a stronger profitability position at the gross level. Thank you.
In this slide, present operating profit ratio and net profit ratio. Operating profit ratio measures the proportion of a company revenue that remaining after paying all variable cost of the production. Net profit ratio measures the percentage of remains revenue that remains profit after all expenses have been deducted. In this explain, Dialog Company operating profit ratio is 11.07% and Mobitel Company operating profit ratio is 7.29%. In this explain, Dialog Company net profit ratio is 11.7% and Mobitel Company net profit ratio is minus 1.62%.
I will be comparing the financial performance of two major telecom companies in Sri Lanka, Dialog Axiata and SLT Mobitel. We will be focusing on two key financial indicators, uh, return on capital employed and return on equity. These metrics are important because they help us understand how effectively each company is using its capital and how much return they provide to their shareholders. First one is return on capital employed comparison. Let's first look at the return on capital employed, ROCE. This metric shows how efficiently a company uses its capital to generate profit. For an example, Dialog Axiata has a ROCE of 8.27%. This was calculated using a profit before tax and interest of 11.4 billion and capital employed of 137 billion. It shows that Dialog earns 8.27 cents for every rupee of capital invested. SLT Mobile, on the other hand, has a ROCE of 4.93 with the profit before tax interest of 5.8 billion. Capital employed 102.9 billion. It earns only 4.93 cents per rupees invested. So Dialog performs significantly better in terms of capital efficiency, indicating stronger operation performance. Second one is return on equity. Return on equity comparison. Now let's return to equity or ROE, which measures the return shareholders get on their investment. Dialog Asiata shows an impressive ROE 21.1%, with a profit after tax nearly 12 billion and total equity of 57 billion. Dialog delivers solid shareholder returns, with just over 1.1 billion in profit after tax and equity 68.1 billion. Return is in negative. So we can identify that Dialog again outperformed the Mobitel offering. In conclusion, positive return to shareholders while SLD Mobitel reflect underperformance in this aspect. Thank you.
Let's analyze these critical leverage metrics. Dialog shows a high debt to equity ratio of 1.89, meaning it gives significant debt financing, compared to Mobitel's more conservative 0.8 ratio. Both companies' debt to assets ratio are concerning. Dialog at 0.76 and Mobitel at 0.64, indicating heavy reliance on broad funds. Interest coverage reveals greater risks. Dialog covers interest 1.26 times, while Mobitel struggled at just 0.36 times earning. This suggests Dialog managed debt better, but both face financial stress. Mobitel extremely low coverage is practically alive.
Let's look at the debt to asset ratio, which tells us how much of a company's assets are funded through debt rather than equity. For Dialog Axiata, the ratio is 0.76. This means that 76% of its assets are financed by borrowing. That's high level of leverage, suggesting the company is pursuing an aggressive financing strategy. Using more debt can help fuel faster growth investment, but it also comes with higher financial risk, especially if interest rates rise or earnings fall. In contrast, SLT Mobitel has a debt to asset ratio of 0.64. This means only 64% of its assets are debt financed, showing a more conservative and risk averse approach. While this may limit rapid expansion, it also makes the company more financially stable in the long time. So, overall, Dialog is more highly leveraged, which can lead to greater returns but also greater risk. SLT Mobitel with lower leverage is managing its debt more cautiously, aiming for steady and secure financial health.
I explained the interest cover ratio under the leverage. Interest cover ratio is how many times company take to cover its annual interest by using its annual operating profits. According to these explanations, the Dialog company's interest cover ratio is 1.26, approximately 2 times. That's mean the Dialog companies take the 2 times to cover its annual interest by using its operating profits. And the other company, the telecom companies, their interest cover ratio is 0.36, approximately 1 time. That's mean the telecom company take 1 time to cover its annual interest by using its operating profits. According to this explanation, the Dialog company is very better rather than telecom companies under this interest cover ratio analysis, because the Dialog company has high interest cover ratio rather than telecom company. That's mean the Dialog companies pay its annual interest quickly and it has the less financial risk rather than telecom company.
Liquidity ratios. Liquidity ratios measures a company's ability to meet its short-term obligations using its short-term assets. The key liquidity ratios are current ratio and quick ratio. According to the presentation, Dialog PLC's current ratio is 2.35. It means Dialog has 2.35 rupees in current assets for every 1 rupee of current liabilities. This indicates strong short-term liquidity. Dialog PLC's quick ratio is 2.34. It means even after excluding inventory, Dialog still has 2.34 rupees in liquidity assets per 1 rupee of liabilities, showing excellent liquidity without relying on inventory. SLT Mobitel's quick ratio is 0.5. It means after excluding inventories, Mobitel has 0.5 rupees in quick assets per 1 rupee of current liabilities. Very poor liquidity it shows. SLT Mobitel's current ratio is 0.56. It means SLT Mobitel only has 0.56 rupees in current assets for every 1 rupee of current liabilities. This indicates weak liquidity and the company might face challenges in meeting short-term obligations.
Now let's look at the efficiency ratio analysis. Focusing on inventory turnover and inventory residence period, as we can see, one company has achieved an impressive inventory turnover of 137.5 times, meaning it sells and replaces its inventory very quickly. This results in a very short inventory residence period of just 2.65 days, indicating strong efficiency in inventory management. On the other hand, the second company has a turnover of only 1.47 times, leading to a much longer residence period of 248.29 days. This suggests slower movement of goods, which can increase holding cost and reduce efficiency.
Let's talk about these critical collection metrics. Dialog converts receivables 2.96 times annually, taking 120 days to collect payments. Mobitel performs slightly better at 3.07 times, collecting in 119 days, just 4 days faster. Both exceed the healthy 90-day benchmark, indicating inefficient cash flow management. This delays available working capital and increases financing costs. The opportunity to reduce in collection cycles by just 10 days could unlock significant capital for reinvestment. For Dialog, we recommend stricter credit controls. Mobitel should capitalize on its modest advantage to process optimization.
When we are moving into slide 11, we can analyze asset turnover ratio, which measures how efficiently each company generates sales from its assets. At a higher ratio, it indicates that utilization of assets to drive revenue is better. Dialog achieves an asset turnover ratio of 0.343. It means slightly outperforming SL Mobile's 0.37. It suggests that Dialog is more effective in leveraging its assets, such as infrastructure and equipment, to generate sales. While the difference is modest, it aligns with Dialog's broader strengths in operation efficiency. As in earlier metrics like inventory turnover, for Mobitel, improving assets utilization could be a key area for enhancing profitability. In summary, Dialog maintains a competitive edge in asset efficiency, though both companies have room to optimize further.
The implementation of our financial analysis, we examine the 2023 annual reports of Dialog Exiata PLC and SLT Mobitel, focusing on key metrics such as revenue, profit, assets, liabilities, and equity. Our analysis was structured around 5 main categories: profitability, return ratios, solvency, liquidity, and efficiency. In terms of profitability, we calculated profit margins, which highlighted Dialog's stronger performance. For return ratios, Dialog again outperformed, showing better return on capital and equity. In assessing solvency, we look at debt level and interest coverage. Dialog had higher leverage but also a better capacity to meet its obligation. Liquidity analysis showed Dialog maintaining healthy ratios, while Mobitel displayed signs of short-term financial strain. Finally, efficiency analysis revealed Dialog's effective inventory management in contrast to Mobitel's lower turnover. By organizing our analysis across these dimensions, we were able to clearly compare the financial both of companies.
Our analysis shows that Dialog is financially stronger than Mobitel. It has better profitability, liquidity, and efficiency. Although Dialog has higher debt, it manages it well with good interest coverage and is well positioned to grow with proper debt management. However, Mobitel is facing challenges. It has net losses and poor liquidity. And while its debt is moderate, low earnings make it risky. To improve, Mobitel must focus on cost control, improving cash flow, and restoring profitability. In summary, Dialog performance overall very strong, with growth potential if debt is managed wisely. Mobitel needs urgent improvements in profitability and liquidity to stay competitive.